Hey, what is up, and welcome to Market Psychology 101, where we look for value in the markets when there's fear and are cautious when there's greed. In today's video, we're doing a special different video. We are going to be talking about the Fed rate cuts today. It's probably going to be the biggest news of the year as far as how it affects the markets. And as you can see, after the Fed has been raising rates to combat inflation and get it down towards their goal of 2%, they held rates higher for longer and finally lowered by 50 basis points. And so it's trying to get a feel out there for how people were interpreting this as far as, was it good news, was it bad news? And I gotta say, maybe it's the algorithms, but at least on X and on YouTube, I saw more videos where people were getting a little hesitant or cautious because, as you guys can see, that after the Fed does start cutting rates, and when they do start with 50 basis point cuts, there tends to be a bad sell-off or recession soon after. You can see the dates at the bottom. So this was the dot-com bubble, this was the great financial crisis, and this was 2019. Obviously, we had the COVID flash crash later. People are saying that sort of priced in what was going to be an eventual recession anyways. But also, and we've been talking about this on this channel for a couple weeks, is that when the Fed has first let off with the 50 basis point cut, that has tended to be more negative in the markets. Now you can see with the dates, this was the dot-com bubble and the great financial crisis. However, there were cuts that happened before the dot-com bubble, as you can see here in 1998. And I've been saying on this channel that I've been leaning towards a 1998 style scenario. And so what does the Fed do? They cut by 50 basis points. So are we about to crash, and are the markets just going to go straight down from here? No new all-time highs. For any of you guys who don't know what the charts look like for the dot-com bubble and the great financial crisis, here they are. This cut right here was at the low in 1998, that 25 basis point cut that I just showed you earlier. Let's reference that again. So this 25 basis point cut is this red vertical line right here. That's when that took place. The market continued to go up a little bit longer. But when the Fed cut by 50 basis points, as you can see, about a year and a half later, that's the bottom. First rate cut, 50 basis points. A year and a half, 2 years later, that was the bottom. Going over to the most recent data point, and this was in 2019, the Fed cut by 25 basis points. And a little bit later, there's a bottom, but there's still room to run before the COVID dump or the priced-in recession that was going to happen anyways. So what do we make of this 50 basis point cut? The markets have been hot, and a way that sometimes I try to step back and take a macro view of the markets is say, okay, where was the bottom? There in October of 2022, and trace it to where we are now. And the markets have gone up 62% inside of a couple of years. So 2 years later, the markets have gone from 3,500 to 5,700. Overall, that isn't totally typical. The markets can run that hot sometimes, but this has gone extra hot lately. So there be a sell-off coming? Maybe. I'm still kind of leaning towards the upside though, as far as there still being more room to run. Maybe that's famous last words, but I'll tell you guys a couple reasons why. First off, with the rate number, I think that maybe people are getting too tricked into focusing on that first rate number, and maybe this is going to be words I eat later, and that's fine. But this is just my thoughts. Maybe we're too focused on the 50 number, and the Fed, from what I read, they may not cut at all next month. There isn't a meeting in October. So if you just average that out over 2 months, if they're cutting by 50 basis points now and they're not cutting next month, well, that's an average of 25 basis points this month and next month. Okay. So what if that happens and then the Fed comes back in November and they say, you know what, we're going to cut by 50 basis points in November. Okay. And then they don't in December. So are we going to average 25 basis points per cut, or are we going to average 50 every single month, or it's going to be higher? What is important to note, guys, is that what does prelude these sell-offs and the recessions typically is when the Fed is continuing to cut at a higher rate. So not just one cut, but this has to continue. 50 basis points this month, 50 basis points continually, so on and so forth. And I was looking up some notes about the meeting. I believe Jerome Powell said something about trying to level off at about 4.4%. Let's go back to the U.S. interest rates, and then we'll hop back over to the S&P. I'll tell you some other things before. So he was talking about getting it down to somewhere around this number right here, I believe, around 4 or so. I think if memory serves, I could be wrong. But okay, well, that isn't as deep of a cut. So maybe they're just going to cut a little bit and hold. Well, when have they done that? So the last two times they didn't, and we know we had the COVID flash crash, we had the GFC flash crash, or not flash crash, but the GFC sell off. But when the Fed cut rates here in 1998, they only cut by a little and then they held. So if Powell's talking about just holding it around 4.4 or somewhere around there, give or take, and maybe I skimmed too fast and misinterpreted the data, let me know in the comments below if that's the case. Again, happy to be wrong. I'm trying to consume as much information as I can after work and then share it with you guys because it's important. But if the Fed is just cutting by a little and then holding, maybe we are here in a 1998 style scenario. Because if they do that and they hold, and I don't know, let's say inflation gets sticky, then we could possibly see rates go higher, or maybe they just continue to hold for a while and we don't get one of these massive quick rate cut cycles as we've had before, which have preceded the big sell-offs and recessions. You can see here in 1993, they did do a rate cut and there was a minor recession, but the sell-off wasn't anywhere near what it was in the dot-com bubble or great financial crisis. So I'm sure they're gunning for a 1993 style scenario, but there's a lot for me to feel like just conditions around the market to say that maybe we're in a 1998 style scenario. Now, I say more of here than here, and one of the reasons why is the yield curve inversion. It's been inverted longer than it's ever been, and as the yield curve starts to really take off and steepen, as it uninverts, that's when the recessions typically come later. So this was the yield curve inversion just briefly. This was the bottom of the market, the red line. Let's keep going back. So this was the yield curve inversion before the dot-com bubble. The great financial crisis. This was the bottom of the market, the red line right there. This was the yield curve inversion. And then the bottom of the market right here, you can see what the yield curve is doing, how long that took. So uninversion to the bottom, about a year and a half or so. But 1993, before that, there was a yield curve inversion late 89, but 93, not so bad with the markets. Again, let's go back on the S&P and take a look at what was going on in a 1993 sell scenario and steadily up. Okay, there already was a big correction in the early 90s. By the way, the white lines, those are peaks in inflation, by the way. So the red lines, at least on the S&P chart, I put as first Fed rate cuts because you guys can see where the bottoms are. The white lines are inflation spikes, okay? Because sometimes the inflation spikes, well, oftentimes, even in the 70s, we can go back there, the inflation spikes can be pretty near the bottoms. And if we come back to today, the inflation spike was pretty near the bottom, okay? So is inflation going to be something that we have to worry about again, as we did during the 70s? There's multiple spikes in inflation. Maybe, I don't know. But as telling you guys other reasons why I think this still has room to run. And another reason is just right here in this channel. You can see that since the GFC bottom, it's been going up in this channel. And as you can see, the height of where the S&P has gone has been in the upper end of this channel. We got supercharged, went back there right after the COVID crash, when there is all that printing of trillions of dollars and record low rates. That is what was needed to get us up here. And of course, it corrected nicely. So we no longer have those conditions. And I don't think we would necessarily get up here. But if we did eventually get to a target, you can see this next little parallel channel here that the S&P would be going for, something around the low 6,000s. I think if it continues to run, that's what I would look for. So there's that factor, is that there's still room to run just by technical analysis to the upside. Now, again, you can look at this both ways. My personal feeling on this all is that these rate cuts, I think, if anything, if there is any bearishness, I would say that would be maybe a year or two down the road, as far as what I'm seeing. But again, the Fed knows more than I do or anyone else. And if the Fed continues to cut at high rates very fast, then I'll change my tune. I think this is likely. Another thing to look at, or that we've been looking at, is two different averages of scenarios that happen without a recession and with the recession. And if you take a look at the S&P and you take a look at this chart right here, okay, you just take the averages of what happens before and after first Fed rate cuts, okay, just kind of imprint this sort of chart movement in your mind, okay, that resembles more of the dark green average for non-recessionary rate cut environments than it does the light green. Okay, so light green, things have been chopping up and down more. Dark green, we even had this 10% sell-off recently in the markets not too long ago. As you guys might remember, or maybe you've seen talks about the yen carry trade and how that unwinded. Again, on my channel, I don't want to get too much into the weeds. Not that I'm an expert by any stretch. You can see right there, 9%. Okay, 9, 10%, 5 to 5. All right, so we've been following the dark green more so than the light green. Talking about the yen carry trade before, guys, I don't want to get too much into the weeds. Again, my essential question when I look at charts, when I'm watching people on YouTube looking at charts, is now a good time to buy? Give me your perspective on that. Is now a good time to buy, not a good time to buy? Tell me, is it more risky, less risky? And I'll just say this. Short term, my gut feeling, my interpretation is that there's still room to run. Short term, okay? I think we're following the dark green line. I also think that, at least for myself, I am not hyper-focusing on this 50 number, because if they don't cut next month, again, that's an average of 25. We will see if in the coming months they continue to cut by 50. Okay, then you can maybe play more defensive with your own sort of investment mindset. But if it's just by 25, I think there's still a year or so to run. I already showed you on the yield curve inversion that even though uninversion of the yield curve is bad and this eventually leads to recessions as it has before, I still think, guys, that look at where it uninverts and where it happens, okay, as far as how long that took. Let's just take the last few points. So you can see there, like around 200 days, okay, so a little bit more than a half a year. Here that would be like 7 months, okay. Here 644 days, so that's like 2 years from uninversion to market bottom. And as far as the dot-com bubble, you can see right there about 560 days, so a year and a half, give or take. And then we were talking about how the bottom was back here in the market. So the bottom wasn't up here. The bottom was with the yield curve. So that data point, regardless, doesn't apply. So, right here, again, we're looking 200 days to 2 years. All right, so where would that put us? 200 days to 2 years. Let's just take a look at this. So 200 days would put us out. We're just going to give ourselves a range and think about there. You see the blue date at the bottom, April of next year. Let's put a pin in that for a moment, because some of you guys watch me for my crypto videos. Remember April of next year. If you watched my video earlier this week on the Bitcoin rainbow chart, you'll know what I'm going to talk about. Let's go to a year and a half, so 500 some days, okay? March of 2026. Let's go to 2 years, somewhere around 700 some. So what is it? gosh, I'm trying to remember 2 years. So 350 times two, yeah, it's about 700. Okay, so 700. September of 26. So, could we be looking for market bottom to form late or mid to late 25 to early to mid 26? I could see it. I'd say that lines up with what some of the trends and the charts are showing. But back to that April number, the reason why that's important, I'm going to go over to Bitcoin here, and my God, let's clean this up a little bit. Bitcoin, we talk about the 4-year cycle, and Bitcoin does pretty well with cycles, and I think that's what sucks so many people into the prediction game, but every time's different. Bitcoin's had these 4-year cycles, so December 2013, trust me, it's December 2017, okay, November 21, okay, 4 years. However, things were different last time, and the top was in April. March or April, we had that early peak, and that's when alt season was. That's when Bitcoin dominance tanked. So that this April number kind of keeps popping up in different averages that I'm just taking it again. I'm not married to it being in April. If it's in March, if it's in May or June, I don't care. If it's around that time, though, I just think that'll be curious or coincident. And by the way, guys, I don't use fractal data or prior date averages to dictate how I invest. I have a plan, and as far as my plan, whether it's Bitcoin or whatever, part of my plan is, okay, I have different indicators that say now's a good time to buy, whether it's this buy sell signal, whether it's this you guys can see this fib retracement. We have the height of the low, looking for lower fibs, greater value. We have these moving averages. I like the weekly, so when it's at the 100, the 200 week moving average or under, I really like that. We have the stochastic RSI. This is a great DCA tool, and that's when it flips positive, blue above orange, and oh my God, it just flipped positive. Bitcoin weekly buy signal, and this flipping positive. So if you were just dollar cost averaging in, like, this could be part of your plan. Now, you have to make your own plan. I'm not going to make it for you, but I'm just sharing some of the things that I do, whether it's for crypto or any stock. So if this is flipping positive and we have a buy signal and the Fed is saying 50, but maybe it's not 50, maybe it's an average of 25, and maybe the charts are looking more like this dark green line, okay, and maybe the time it takes from uninversion to the eventual bottom is still a ways away, then we might still have up to a year, maybe, guys. I don't know what's going to happen, but we might still have some time for things to run. And if that's the case, as far as how I'm approaching this is, for my stocks, I'm going to play more conservatively. I'm going to play more defensively because I don't see as much upside in stocks in the near term, okay? Now, there are some other stocks, like there's some dividend stocks. I like, Pepsi, 3M, John Deere and stuff, some of them that have been at recent lows. Heck, even Starbucks was at, let me go out to the monthly here. It was at the 100-month moving average not long ago. Okay, so overall, on average, decent value time to buy. Okay, it's not as extended from the moving averages. So I might play more conservatively with the stocks. And when I think of stocks to put my hard-earned money into, I do my research. I look at the assets to liabilities, make sure it's a good ratio, research other things in the company. But I want to make sure, or I want to believe in my bones that whatever company I put my money into is going to be around in 20 years. Okay. Stanley Black & Decker, Milwaukee Tools, under their umbrella, I believe they're going to be around. John Deere, I believe they're going to be around. Pepsi, they're not just soda. I believe they're going to be around. 3M, they've been around forever. Costco, great stock. So I look for when those are good values, and I'll just be patient with those. Now, as far as crypto, we talked about crypto, how it moves in cycles. And have we had a cycle top? Well, no, not really, because when altcoins have done well, when, let me take off this indicator, when mining stocks have done well, we had this sell-off with, let me put on the weekly, with Bitcoin dominance. That has not happened yet. Bitcoin dominance is still going up. Now, this percent of 62% is my target, and we'll see if it gets there. But if it starts to all of a sudden break down to the 40%, that's when I'm going to say, okay, with my more risky assets, and again, I only invest what I can afford to lose, and I do set myself a strict budget that I never exceed to pull money from. And by the way, I don't have to spend for my budget if nothing is in a good buy range, as I just shared with you some factors I look for. But if Bitcoin dominance is a breakdown, then I can make some possible good money if I'm in the right altcoins, if I'm in the right cryptos, the right Bitcoin miners. So that's what I'm looking at. But in the back of my head, again, my interpretation, again, comment below if you agree or disagree. You're more than welcome to disagree, and please share why. That's what I'm looking for. And I've sort of set a timer in my head of, okay, maybe the markets have a year or two. If Fed Chairman Powell is saying they're targeting somewhere around 4%. Oh my, I spelled it wrong. If they're targeting something around 4.5%, okay, that's not much lower. And that's kind of like what they did in 1998, right? He wasn't saying getting it way down here to zero. They don't want to say there. What's the word? Nominal rates, like eventually they want to reach somewhere between 3 to 4 nominal rates and staying there. We'll see, so maybe they'll go down to 4.5 and they'll just hold there for a while. And it's possible, guys, that, as it cuts, we might see bearishness just in the short term. But as they've held, that's when we've seen bullish action in crypto last time around. We only have this data point, really. But after the cuts were bearish. Okay, I'll show you this on the crypto chart. The orange vertical line, that was bearish for a bit. But once the Fed paused, and they paused somewhere right around here, December 19, I believe. Once they paused, that's when crypto started to go up. Obviously, COVID crash, but then you had the stimulus money. So again, I wouldn't be shocked to see a little bit of bearishness. Again, I don't care if it does or doesn't. I have a dollar cost average plan, and whether the market does what I think it'll do or not, it doesn't matter. I stick to my plan, and I have a position, and I'm happy with that. I have skin in the game, and I'm putting my money where I believe, hopefully, it'll run. We'll see. None of us are perfect. But if we are to be micro bearish, and then after a few months, 4 months, they pause, that's when I could see things starting to go up. And then just, we have that, 6 months to a year of just really great action in the markets. And then, as everyone says, soft landing achieved. Again, this is just a scenario I'm playing out in my head. Soft landing achieved. We're at the top. And I'm going to be like, you know what? I'm pulling profits. I'm taking my realized profits. Bitcoin dominance, it's down to 40%. I'm going to take my money and go. That's part of my game plan, okay, as far as when to take profits for myself. But we'll see. Every time is a little bit different. Who knows? Maybe the Fed will surprise me, and all of a sudden they'll continue to cut by 50 basis points or more. They won't stop at 4% or 4.5%, whatever Powell said, and they'll just go lower because the economy's in the crapper. But, guys, I'm still feeling that 1998 style scenario. I'm going to leave it there. Let me know what you think in the comments below. Do you think I'm misinterpreting this? Do you have a different perspective? I really am interested to hear what your guys' thoughts are. But again, very important news, probably the most important news. Now we watch. Does the Fed continue to cut rates in an aggressive way? If they do, that's bad. If not, I think even if it's micro bearish, once they pause, if they pause around 4.5%, that's what I'm going to be looking for. Look for the pause and look what markets do at the pause. If we get another little flush that might freak people out, I would be, if there is another flush, I'd be looking to add to my positions, especially in the world of crypto. And if any solid stocks, hit some of those moving averages or lower fib areas, as I showed you guys as far as how I look at my plan. So anyways, hope you guys enjoyed the video, and yeah, we'll see what happens. So, and I'll continue to share news about this or updates about the Fed news as we go forward. So anyways, thanks for watching, guys. Take care.